following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
All right, we are back, NinjaTrader Live. My name is Jim Cagnina. Joining me live, Brent Kachuba, Spot Gamma. Brent, how are you?
I'm doing great. How you doing?
Pretty good. Cannot complain. Getting ready for the holidays, as I'm sure you are, with the two little ones at home.
Yeah, that's right. I got two little girls, and they are pumped for Christmas. I remember those days when I used to be super pumped for Christmas.
Yeah.
That was about managing costs, you know?
Yeah, exactly. You want what? Yeah, and sometimes your kids are smaller, but they get a little older, and it's like, hey, I want that iPhone watch, the iWatch or whatever it is. It could be $900 on that guy.
That's right.
She's like, no, probably not. How about a Timex? I'll tell you the time.
Yeah, that's exactly right.
Oh my God. So this should be a big deal, right? This is options expiration Friday, triple witching, end of the calendar year, tax harvesting, FOMC meeting. The seams are about to burst. There should be some stuff happening.
Yeah. It's I think it's going to be the biggest options expiration ever. I mean, odds are we'll see kind of what happens in the next few days here. But in terms of size, Friday will be the biggest options expiration ever. And we have FOMC obviously on Thursday. So, there's a little curveball coming there. And what's interesting is if you look at the breakdown in volatility, if you look at value like Russell or the equal weighted S&P index, for example, those are getting beat up pretty good. They're down like 10 out of the last 10 days, for example, whereas the NASDAQ, Apple, Google, Meta, Mag 7s are at highs. Tesla's just, I don't know how you describe what Tesla's doing. It's up something like 75% since the election. And obviously crypto's doing well. So there is this divergence between, the correlation, right? Meaning that not all assets are participating in this rally. And, to your point, tax loss harvesting or end of year flows or whatever it may be, not everything is kind of syncing up.
Yeah.
So normally I would say here that this is a real turning point for the market, December OPEX with FOMC. I think that there's a 100% chance of a rate cut, or as close to 100% chance of a rate cut if you look at the CME. That's what they're projecting. But the forward guidance is going to be interesting, and I think the market is a little more unsure now about forward guidance out of the Fed. It's not my specialty. It's just this is more uncertainty, I think, than we've seen in terms of the forward guidance aspect than we've seen over the last maybe year of FOMC meetings. So normally what I would say is we're going to pull away a lot of the flow that's stabilizing the S&P 500 and maybe driving some of these Mag 7 names right at the year end rated with FOMC. The curveball there is that I think there was a Goldman chart that came. Well, I know there's a Goldman chart, but these last week of the year is one of the strongest weeks of the year historically. So that is the other little curveball that comes in. But to me, there's a lot of signs that we're kind of in this topping phase here into January.
Yeah, but take a look at the NASDAQ though. I mean, it's on fire, man. It's like every day it's like all-time high, all-time high, all-time high. It doesn't stop.
Yeah, and that's broadly, I mean, you have the Mag 7s which are doing very well. NVIDIA. NVIDIA looks horrible right now, and that was the stock that drove much of the rally, right? I think Tesla is eating their lunch a little bit in terms of market performance. The quantum chip sector now is something that is just ripping. And, I listened to a few things or read a few things about that quantum computing thing, and it sounds like it has great chances of becoming something legitimate in like 5 to 7 years, I guess. So, I think there's just a lot of frothy sentiment right now. And so you're just breaking apart, the rally's breaking apart is I guess is the way that I would kind of put it. But to your point, NASDAQ right now is very strong. And so that is, that looks good, but compare that to the IWMs, or Dow, which doesn't, certainly look quite as good. And, there's a lot.
By the way, on the quantum computing, did you read somewhere? I read somewhere that if this is legit, this is real, it's going to be able to mine all the existing Bitcoin in like a day.
Yeah, I think, these are all the things that I don't know. And I think, I was reading about some quantum name being up yesterday. It had something like $240,000 in revenue last year, and it was up, 70% the last week or something. So, this is a market that is really rife with speculation. And you see that in MicroStrategy more so than anywhere else. I was talking with our subscribers about the fact that, I've been doing this for well over 20 years now. And there are these moments in time where you see stuff where it is just really stupid. And it's things like, I'm going to get a loan out on a house or my car. I'm going to take that money, I'm going to put it into a stock because that's free money. And those are the types of behaviors that, you can set your watch to it, your Timex watch to it, that there's a bubble, right? And I remember this so well in the housing crisis in 2006, where I was working at a bank and I was like, hey, I'm doing pretty good. And then I had a friend who was kind of like a college dropout, and he was driving this Escalade, and I was like, I don't really understand how this is happening. Well, he's buying houses in Arizona or whatever, it's like one of those crazy stories. Or GameStop in 2021, right? Where people were financing their houses or going all in on crypto at these wild prices and things. And so, Bitcoin's got a future, sure, but I just think that the path isn't always straight up to these assets, right? And when you start to invoke leverage and all these other things, that's how, I like to say, that's why we can't have nice things, right? So, a lot of those signs are there in this market. The other interesting thing I would say is if you look at the options landscape, realized volatility, so how much the market has been moving, is at extreme lows, kind of at a lower bound, right? You have to have some movement in the market every day, right? But the amount of movement we've had now is really, really tiny. And that's at like pre-COVID levels or approaching pre-COVID levels of stability in the market. So the market's really not doing much. And the cost to hedge the S&P 500 now is extremely low. Earlier this week, we saw prices that were kind of like the lowest we've seen since like pre-COVID crash. So, the cost to hedge is extremely low right now. And so when you juxtapose the fact that the market's had this incredible run, S&P 500 or the NASDAQ, and the cost to hedge out those positions is basically next to, nothing, 12% implied vol, that's telling me that might as well buy some insurance, right? Because you made a ton of money. Well, let's sprinkle a little bit out in terms of insurance. The problem with that low implied volatility pricing is that the market is pricing in no movement, almost next to no movement, right? 20 handles is what it priced today, for example. And so if you get a little bit of movement, then suddenly that breaks down the paradigm and causes people to have to cover, and it shifts things, right? Because if you're expecting no movement and you get a little bit of movement, then suddenly you're like, oh, what just happened? And you're kind of shocked, right? So a lot of these things are kind of like congealing or meeting at the same time as we get into the end of the
So really quick, if you mentioned both implied and realized volatility, is there a meaningful difference?
Yeah, a realized volatility looks at how much movement the markets has. So you can call that historical or realized volatility. It's just a measure of saying, okay, over the last month or 5 days or whatever your window is, typically we look at 1 month, how much has the S&P 500 been moving? And the answer is not much, right? It's somewhere around 10% to 12% implied or 10% annualized movement, right? That's not very much really at all. And so when you say, okay, great, what is the market projecting in the future? It's a little bit higher than that, but you can buy, for example, a 1 month 25 delta put, which is a decent hedge for, let's say, a 3 to 5% market crash. You can buy that at a 12% implied vol. So what that's essentially telling me is that your cost to hedge is assuming that there's not going to be any volatility in the future, right? Because we've had no volatility last month, and the market is just projecting no volatility out in time. And so, if the Fed upsets the paradigm Thursday at all a little bit, if some of these hedging flows are supporting the market and they go away on the Friday, that could allow for a correction in the market. And, this doesn't have to be a crash, but we've not had a real correction in quite some time. And what this is all setting up to look to me a lot like is August, right? August, we had just this incredible rip higher in the time it was NVIDIA driving the market higher. Now we have crypto, Tesla names like that, right, that are doing the same thing. They're stretching the market higher. And all that resets. It's the famous saying, escalator up, elevator down, right? And I think that people are like, whoa, the VIX hit over 60, remember, in early August. And, maybe we don't get VIX 60 in this situation, but the idea that vol jumps meaningfully higher and everyone's just sort of like shocked, that seems to be kind of like a setup that we could be facing into January, just based on the stretch pricing.
So why is it that this is the all-time biggest options expiration?
December is always the biggest expiration. The options complex is growing a lot. It still is continuing to growing a lot. If you look at the percent of options that are 0 DTE now in the S&P 500, for example, we're now at about 55% on an average basis. If you look at the volumes in Tesla, NVIDIA, even MicroStrategy now is a top 10 options name, those volumes continue to grow and increase. And then when you've had a substantial rally like we've had since the November election, that increases the value of these positions as well. So if you look at the value of calls to puts right now, we call it a delta notional, but it's kind of a stock equivalent basis. It's over 10 to 1 call values to put values into this expiration as well. So it's the most notional value you've ever had expiring on Friday, making it the biggest expiration ever. Goldman has this measure, which I don't love, but it's the way the media likes to quote it. It's $7 trillion worth of open interest value. Which makes it the largest ever. Our measure is somewhere around 1.7 trillion in stock equivalent expiring. So there are a lot of positions that are going to be shifting into and around Friday, and obviously you have the Fed right before that. And then that goes into this next trade next week, which is the well-known JP Morgan collar trade, which expires on 12/31. There's 45,000 contracts of S&P options at the 6,055 strike. And so our view here is that if the Fed doesn't spark a big move, and usually they don't, so if they don't do it here, if we open on Monday between 6,100 and 6,000, then you really got to start looking at pinning that 60.55 strike into the end of the year, because that JP Morgan position generates so much what we call positive gamma, which is just pinning flow. And you can reference this if you look at the end of September, right? What did we do? We pinned this level 57.50, and we didn't budge until 9:30 OPEX, and then as soon as that pin was pulled there, those contracts roll. The contracts that line up at the end of the month, end of the quarter. When that JP Morgan position goes away, then the market starts to move again. So we could end up with this weird arc here where we just sort of pin into end of the year. It's really sleepy, and then that final pin is pulled on 12/31. So there's a lot of stabilizing positions is the takeaway here that are going to be removed into year end.
Okay, so the paradigm could change significantly in January.
Yeah, I think into January. I mean, the single stock implied vol, when you look at the leaders, is pretty elevated, right? Like when you look at Tesla, the cost of buying Tesla calls right now is really crazy. Now Tesla continues to go up at a torrid pace, and maybe that just continues indefinitely, into time. But the problem is that at some point these calls get so expensive that they don't pay off anymore, right? And so there's this natural flow in the options market that starts to work against, it's how moves start to stall out. And so that stuff that is the leader that's leading the market right now is getting, again, it's very stretched. The implied vol on a lot of these names is getting really high, and it's a deterrent to buying more call options, which I think is oftentimes a catalyst for stocks to go higher, right? So you're getting these stretched valuations in the leadership, and then under the hood, again, you look at equal weighted S&P 500, or you look at the Dow, things like that. Those names don't really have much of a bid. So if I'm wrong on this, and you see broader leadership pick up, and you see some more stocks start to move in kind of unison, in other words, correlation starts to move up, well, then maybe that's a sign that this isn't going to happen. But the way that I look at this is like, if we break 6,000 to the downside in the S&P 500 S&P index, then that's the sign to me that the downside is going to come, and that's my kind of risk off signal. So that's how I just bake all this down, right? We're okay as long as we're in the 6,000, particularly around the 655 area into year end. But if we break 6,000, then that's kind of the risk off shot. And on that point too, you got to really watch crypto. I think crypto is the more speculative asset. And so if crypto starts to move lower, then I think that's also another kind of shot across the equity bow, so to speak, that we're due for kind of a correction.
So kind of a risk off environment.
Yeah, and the reason I picked 6,000 is because under 6,000, we lose what we call positive gamma, right? We're going to lose a ton of positive gamma due to expiration, just period. But if we start to go under 6,000, that's where there's more net put positions in the S&P 500. That's where I'd expect implied volatility start to lift up. And that's where you get these dealer flows that can start to accelerate downside in the market. And so, I think that with these moves, right, you don't want to preemptively sell everything right in your portfolio or start going crazy buying a bunch of hedges. And implied vol is so low and we're so high that if we get that first shot, right, if we break 6,000 and vol starts to move up, you have time to hedge and cover your portfolio and react to that, right?
Yeah, so, but also isn't gamma though a function of time, right? So what's the time frame at that? Where's your 6,000 line in the sand from a time frame point of view?
It goes into the end of the year because there are big positions at 6,000. It's a big round number. So yes, we're going to lose a bunch of call positions and put positions. We're going to lose a bunch of positions period into 1220 OPEX. And then there's that JP Morgan position, which is big enough to hold the market into the end of the year at 60.55. So if we break 6,000 on FOMC day, then the gamma of that JP Morgan position starts to reduce significantly, right? Gamma is highest for at the money options and increases as we get closer to expiration. So if we break 6,000 before that, then that position starts to not have as much effect in my view. And then on the flip side into the new year, there's still enough positions below 6,000 that vol could start to pick up, right? That dealer hedging flows could start to push the market down. And so to your point, we're going to lose in probably a third to a half of the options complex positions in the market into year end. So that is just destabilizing in and of itself, but that doesn't necessarily have to be bearish, right? When you lose that positioning in the market, it unpins things, allowing the market to move. So the edge where you go, okay, this is more likely maybe to express itself to the downside, I view as that 6,000 level because there's, again, mainly puts below that 6,000 mark. And to me, that put flow and put hedging flow is generally associated with higher volatility in the market, right? That's where you start to see the VIX pop and you start to see maybe some downside market movement. And then the other thing about this that's interesting is there's always a big January expiration. And we saw this in 2021 where there was a violent move to start January 2022 to start the year. And I think a lot of that was related to deep in the money calls that expire in January. And so those positions exist in the market as well. And so there's plenty of fuel to have a very volatile January in my view. You need to kind of get like the market shove and so, again, if we break that 6,000 on the downside, that's my idea that there's plenty of fuel even in single stocks that you go, okay, if S&P's risk off, then that probably means these single stocks are kind of correcting as well. And, on the same point, you look at, I saw a chart, Apple's trading at 10 times sales, never done that before. So, there's these other metrics that just say, look, this is all feeling a little bit stretched. And so I think when things are that stretched, there's plenty of fuel to bring that, corrective volatility to the downside.
No, yeah, Apple knows you're not buying your kids that $900 watch. So that's why.
I mean, I was listening to, I don't know, everyone listens to this All In podcast now, and they were all complaining about their iPhone. And this has nothing to do with sales, but I was like, I'm not the only one. I thought my phone was just going crazy, but it's just like, it's kind of garbage. I don't know. So it's like, what does that mean about the stock price? I don't know. I just think that, it's just like, you see all these signals, and it's like, you sit there after a market correction, you go, were there signs? Yeah. But
in January too, we're going to have a new administration stirring up the pot that could change a whole nother shift.
Yeah, there is that the inauguration, obviously, and I don't know, who knows about the political aspect, but the FOMC is right around the time of Jan FOMC is right around the time of inauguration. Yeah. It's right around the time of all these options expirations as well. So there's a lot in that second, third week. Tesla earnings is right around that time. So there's a lot in that second, third week that of January that can be this catalyst for change, right? And so, if we were crashing into that event, I'd be probably looking to buy that dip maybe. But you really want to circle that third week of January on your calendar as well, as a possible date for change, right? A turning point.
Yeah, no, that makes sense. Now, so we're futures traders, right? So we look at the futures price versus the underlying cash price. When you mentioned 6,000 and 655, that's what you're referencing.
S&P cash is what I'm referencing. Yeah.
Yeah.
Yeah. And the reason I quote S&P cash is because obviously the futures kind of, basis or the difference between the future and the index changes quite a bit. Right. And the options positions are all struck to that, So like when you load our levels into the NinjaTrader platform, we do that adjustment for you. Each morning we load fresh levels into the NinjaTrader platform. And so we are adjusting that spread, but everything I'm talking about is in reference to the cash price.
We're like 20 minutes into this thing, and we haven't even looked at a chart yet. Is it? is there a chart you want to show or no?
Yeah, I have a couple charts I can show for sure. We look at the size of options positions, and so I don't know if you can see this here, but what this is this is showing what we call open interest notional. This is the way that Goldman kind of likes to look at it, and the media likes to quote it. So this number is a little excessive, but apples to apples, it's the biggest expiration ever. We like to look at the stock equivalent. So what this does is it assumes that open interest is worth 100 shares of stock, which is not always. So the thing that I find interesting about this when you're trying to characterize how big the options expiration is, and actually let me see if I can make this a little bit bigger. You see that better now?
There we go. Hang on, now we're talking.
Now you're talking. All right, good deal. Yeah. So this is the size of the S&P index complex expiring on Friday, whereas this is ETFs, and then you have single stocks right here, these two squares, and then other indices like NASDAQ, Russell. So the S&P 500 is bigger than the rest of all options combined. I always think that's an interesting thing to put into context for people when you're thinking about, well, does the S&P matter that much? Well, a half to total expiration is of the more than half of the total expiration size is in the S&P. So that really matters. Obviously, the biggest index in the world, and the options flows are massive. But this is the size of call positions. So this is what we call delta notional. This is how we like to look at the size of expirations. This is the size of calls in blue versus puts in orange expiring. So you can see this is the December expiration. We're easily 10 to 1 in call values relative to puts. This is very concentrated in a specific set of names, obviously, right? Tesla, Apple, et cetera. But this is that Jan OPEX, which for the S&P, Jan is not a huge OPEX, but for single stocks, it is. So you look at the next, call it month, 4 to 6 weeks, there's really significant options expirations here. And I think that these will be really meaningful to what we're seeing happen in the S&P 500 or in equity markets generally, I should say.
I got it. Wow. Okay.
Yeah, and everyone here who has ever heard me talk knows that I look at significant options expirations as potential turning points in the markets. But you look at 2021, right? We had this incredible rally here. And then you have your year-end expirations, and so you get that year-end rally, and then this is where we give it all back. And that low right there, I know my drawing's not great, but that low is Jan options expiration. And so when I'm kind of thinking about the potential for volatility and stuff here, this paradigm or that sort of not paradigm but comparison, lines up to me a little bit, because we have this 2021 kind of sentiment. I feel like, right, meme mania a little bit with some of this stuff. The other thing that was interesting to me about 2021 is that the Fed said they were going to start raising rates. And I know that we're not going to start raising rates here, but the idea is that we're going to stop lowering them. So that interest rate change, paradigm is kind of coming back into view a little bit. And to your point, new administration, all this other stuff coming up. So, there's a couple of reasons here just to think that that some contraction is warranted from a couple of different reasons. Certainly we see from the implied volatility and position changes that possibility is lining up.
All right. So we're gonna follow that as a template, possibly.
Yeah, and I think this is the size of options positions volumes on a daily basis, right? Or an ADV, and so this continues to increase. The options impact continues to increase, and I just think it's very simple. Like if we break that 6,000 S&P cash level, to me that's the sign that all of this risk off stuff is going to come, and I have these options flows that back my reasoning for that. But as futures traders and the NinjaTrader platform and stuff, you can just kind of draw that line in the sand and say, okay, under this level, this is where the options market starts to work to the downside versus being supportive of the market writ large.
All right. I gotcha.
And we put this, we try to simplify this stuff in our notes, because there's a lot of lingo in here and stuff. And so when you look at this, right, you can see that there's that 60-55 level, right? We have this level called the call wall, which is at 6,100. That's where the most call positions exist from a gamma perspective in the S&P index. There's also tremendous amount of spider positions there as well. So there's a lot of reason to think at least into 1220 expiration that is a real line in the sand to the upside. And so, there are these big positions. It's kind of like a field goal post, right? Before I was making a bunch of Justin Tucker jokes about this, and that people didn't love that. Somewhere in here, I have the chart I want to show you. Sorry, there's a lot of charts in here. Everyone that was from Europe or overseas didn't understand that joke whatsoever, but couple of the US,
I got it.
US people got it. But you can see the size of these positions, right? This is 6,000. This is that 6,100 level. And a lot of these are going to be, so we're going to clip a bunch of this size, right? But I was talking about the put positions being large or below. So blue bars in this case are puts. And you can see that relative to calls, right, those positions are a little bit bigger. And the thing about this is that if the market starts to move down, the gamma of those put positions is going to increase, I think. And volatility will spike. And that's what the predominant view of that downside to me.
But on the flip side, on the other side of the chart, you got bigger call positions when you're outside of the goalpost. So that's
you're 100% right on that point, Jim. The way that this works in the S&P 500 is, I mean, you've heard of the JP Morgan Collar Fund, JEPI, which is this giant $30 billion, call selling ETF. Like the S&P 500, what people do is they sell calls against their holdings of stock, right? And so most of the time, these calls, these orange bars, are calls being sold, kind of like that JP Morgan position. That is positive gamma for dealers, which helps to support the market when we go up. And so those are stabilizing positions, and we tend to kind of like drift higher and drift higher. Now, what's interesting about this is that we've gotten stuck into options expiration, right? Part of the reason that I think the market oftentimes drifts higher is because volatility comes down. So like when the VIX comes down, that's a lever to push the market up. Well, the VIX has stopped going down. Vol stopped going down because there's nowhere else for it to go. Remember, we were talking about realized vol versus implied vol. It's at like a floor. So if VIX, in other words, or implied vol can't drift down, that takes a leg out of the market fuel for us to rise higher. And we're just kind of we're just sort of stalled out, right? So you can make a case that we almost need a little bit of a pullback or downside to help us kind of, take a second leg up. But if I'm wrong in this and we start to break out a little bit, then I would expect call sellers to come in here, and you'd see these orange bars increase, and we kind of grind a little bit higher. Take, for example, yesterday, the NASDAQ, I think, was up at 1.5%, right? And the S&P was only up 50 bips. That to me is that positive gamma effect, right? It squishes the S&P, keeps it kind of in a straitjacket, and you see relative movement in other indices quite a bit more.
Yeah, awesome. All right, man. Well, listen, we're up against time. I really appreciate you being here with us. Best way for people to find you, Spot Gamma?
Yes, sir. SpotGamma.com. You can find me at SpotGamma on Twitter, and we'd love to see you all over there. So thanks for having me, Jim. Happy holidays to you and everyone at NinjaTrader. Really appreciate you having me on this year so many times. I feel very fortunate to present to your community. So thank you very much.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.